Happy Friday, everybody, and welcome to Yahoo Finance Live. You feeling it?
I'm feeling it. I'm feeling the Friday energy.
Man.
It has been a long week. A lot of earnings reports, you know?
She's Shauna. I'm Dave. Let's get you up to speed on the market action on this Friday. And the markets are feeling it. They're feeling Friday. Just under an hour left in trading. Stocks are popping, man. The Dow's up 346 points, more than 1%. The S&P is up 1.5% and leading the way. Tech stocks. Wowza, up nearly 2%, 219 points to wrap up an interesting trading week. And one of the biggest movers of the day is C3AI. The AI company soaring after a better than expected earnings report. Just one of the many stocks seeing a boost from AI. Coming up, one analyst explains why artificial intelligence is, quote, the new electricity.
Certainly is a hype word, it seems like, on the street as of late.
No doubt.
All right, well, we are also watching shares of Exponential Fitness because take a look at this move. The stock is skyrocketing up just about 17.5%. The move higher after the company posted better than expected fourth quarter results, on track to close at a record high. The company's CEO is here to talk about the quarter and the trends that he's seeing from gym goers this year.
You dig the Pilates, do you?
I do dig the Pilates. I should do it more, though.
I've never tried it. I've done the row house quite a bit.
I'm actually surprised you've never tried it.
I like my yoga.
I feel like you could get
I just
into
never
it.
tried Pilates, but I will.
A reason to go.
First, let's get you up to speed on the Fed. Loads of chatter from the central bank this week, and Yahoo Finance senior reporter Jen Schonberger joins us now to break down the latest for us. Jen, nice to see you. Happy Friday. What are we hearing now?
Good to see you. Happy Friday to you. The Federal Reserve out with its monetary policy report to Congress ahead of Fed Chair Powell's semi-annual testimony to Congress next week. In this report, the Fed underscores that although inflation has come down from levels seen last June, it still remains too high, and that thus ongoing increases in interest rates are required to bring inflation back down towards the central bank's 2% target. Now, this will likely require a period of below average growth and a softer job market, according to the report. The Fed noted that financial conditions have tightened significantly since last June, but that valuations in the stock market remained notable and ticked up on net as stock prices increased moderately even as earnings expectations declined. The report also said that market functioning remains orderly, but that market liquidity remained low in several key markets, including the Treasury market, compared with pre-pandemic. The Fed said it is prepared to adjust the winding down of its balance sheet should economic or financial conditions change enough to require that. Now, separately, Dallas Fed President Lori Logan said in a speech Friday that the Treasury market remains vulnerable to dislocations and that the Fed should improve its tools, including repurchase agreements, to better assist markets in turmoil. Now, Susan Collins of the Boston Fed said in pre-recorded video remarks that inflation remains too high and that further rate hikes are needed given recent inflation data. We will hear from Richmond Fed President Tom Barkin at 4:15 p.m. Eastern on his outlook for inflation when he speaks at Stanford University. Guys.
It was just nice they didn't talk the markets down on this Friday. Have a great weekend, Jen Schonberger. Thank you. Let's get you up to speed now on Treasury yields and their impact on all corners of the economy. You can see bonds retreating slightly from their recent march. The 10-year moving below, then back above the key 4% level today after services data showed economic activity expanded in February. Of course, we're fresh off the single largest calendar year increase in the 10-year going back to the 1970s and the worst ever year for bond investors. And just when it appeared bond yields were retreating, data started showing stickier inflation and a hotter than thought labor market, prompting language from the Fed, as Jen Schonberger just alluded to, indicating rates would be higher for longer. Where do you see that pain most immediately? Right there on your screen. Home buyers are feeling it. Seeing that sudden increase in mortgage rates, most experts thought they'd retreat near 5% in these few months. Instead, they are climbing back towards 7%. The inflection point came 1 month ago, Shauna, February 2nd, and that was the point. They were just over 6%. We thought headed below that threshold, Instead, boom, right back up in the last 30 days.
Yeah, certainly more pain here for borrowers. And it's not just housing that these higher yields do affect. I mean, when you take into account the movement that we have seen to the upside, it impacts rates at which companies can borrow. And we bring this up because that can affect future investments. So those higher yields here, businesses facing higher borrowing costs. And Dave, you mentioned that environment that we seem to be in right now, the higher rates for a longer period of time, given the resilience that we're seeing in the economy. The reason why we bring this up is how it affects you in a number of ways. It's not just housing, it's not just these big companies, it's also car loans, and it's also credit card rates, just to name a few. When you take a look at some of the recent data that's been out from Bankrate, average credit card rate trending to the upside, 19.9% as of the most recent report. That was the end of January. Car loans, which tend to track the 5-year, but that's also trending to the upside. So it means that you're paying more to borrow for that car that you drive. The average rate is 6.5%. That was in the fourth quarter, so we expect that to continue to the upside, up from 4.1% the previous year. So certainly it impacting a lot of people in terms of their everyday borrowing, what they are paying on a month-to-month basis. What I also want to point out, Dave, is the trends that we're seeing in the 2-year in relation to the 10-year and this inversion of the yield curve. And what this exactly means is that the yields that the 2-year is giving right now is higher than the yields that we're getting from the 10-year. So I want to play a quick shot from what we heard from Jeff Bierman. He's TheoTrade Chief Market Technician yesterday on what exactly this signals moving forward.
But the 2 is accelerating at a faster pace on the yield than the 10. Definition, translation, you're in an inverted yield curve, which signals a recession, and we're accelerating into that recession because the delta or the divide between the 2 and the 10 is getting wider and wider by the day. That's why the market's on its heels. It's backing off because it's saying, are we in a recession? Are we not? We're accelerating faster into one based upon the inverted yield curve. That's what I'm seeing.
Well, this inverted yield curve, we've been talking about this now for several months, a predictor of a recession, a reliable predictor at that. Yet we haven't seen this recession, but there are still fears out there about what exactly this economy could look like, not only a couple months from now, but in the next 6 to 12 months as well.
Is it a reliable predictor? That's the big question. It just doesn't appear that there are any signs of a recession out there. We talk about the labor market. And let's talk about, for example, tech stocks, right, Shauna? We should see them falling this year with higher 10, and what are we seeing? 11% rise in the Nasdaq, outperforming the S&P, outperforming the Dow, and up today 2%. So up is down, down is up. I don't know if it's going to be the accurate predictor that it was.
I hope it's not.
It sure doesn't appear to be at this moment. Okay, with seemingly every cornerstone company from Google, Microsoft, and Meta, and Amazon clamoring to enter the AI fray, one Bank of America analyst is upping the ante, saying artificial intelligence is the new electricity. Let's welcome in, said analyst, Bank of America, head of global thematic research, Chaim Israel. Nice to see you, sir. Happy Friday to you. In some regards, though, we have heard this before. We've heard it with Bitcoin. We heard it with NFTs. We heard it with Metaverse. What's different, in your opinion, this time around?
Well, we need to remember one thing, that AI has been a technology that's been with us forever. But up until now, it was just a handful of people, was some kind of a black box. No one really know what it is, and some very fancy and sophisticated algorithms, which not everybody could use. What happened in the last 4 months were really what we call the iPhone moment. Technology went mainstream. Technology became what we call the democratization of data. Anyone can use it. You don't need to be an expert. You don't need a proper education. You don't need to be a scientist, computer scientist to start using AI now and practically do everything with it. As a result, we've seen that turning to what estimate right now 100 million users in less than 4 months. No other technology have been spreading so fast. Applications are unprecedented amount of applications that could be based on the back of it. And the technology itself is just warp speeding in terms of how fast it's developing. So I think that now it's just exactly where the iPhone was in 2007. We are about to start seeing more and more application, real value, which is coming on the back of that, real proper apps and ways to start using it, unlike some technologies we've seen in the past.
Yeah, Chaim, some figures here in your recent note just talking about that adoption rate, unlike anything we've seen before. It took Netflix 3.5 years to reach 1 million users, Instagram 3 months. For ChatGPT, it just took 5 days. And certainly that trend has, if anything, accelerated here to the upside. If we're still in the early stages of AI, how do you see that then evolving over the next several years?
I think it's going to continue to be mass market. Exactly. You know, if we were looking, I'm using the example of the smartphone itself, that no one understood it's going to be. Now there are more smartphones on the planet than people actually today. And I think that AI is heading in the same way, that for now, we all can use it. And there's just any application, we can start mining data, we start using data, we can ask the program to start doing stuff for us. I just think that the applications are unprecedented of what's going to happen over here. And I cannot think about even one industry that will not be able to use it. Again, like the smartphone, like the internet. Think about, did you believe that back in the 90s, there's not going to be even one industry, one company that will not be, that will not use the internet, that will not cooperate on the internet, that will start using data with real value? This is exactly where AI is heading right now.
Remarkable. You think it will touch every industry. Of course, all the focus initially was on one, and that was search. And that was Google versus Microsoft, or Bing, if you will. How will it impact search in your estimation?
Well, I think the thing is about with search right now is that we're using search. We're getting a list of sites that we can start using and digesting the data ourselves. The fact that right now all the chatbots out there, ChatGPT and all the other applications we're starting to see, start digesting the data for us and give the data for us. As a result, this is why I think it's not just for me, it's not just for you. Every industry can start using it. Think about heavy data industries like healthcare. No, the biggest database on the planet right now is actually around healthcare companies, genomics, and so on. Think about materials, chemicals. We cannot even comprehend getting even close to start using all the data out there that help us to build a better chemistry, better materials, and so on. Think about logistics, think about commerce, think about all the stuff that we keep using data. There's so much value added over there. So it's not just for me and you that we start like we're doing now. We're Googling, we're using search engine. It's actually getting data much more at our fingertip right now without us digging, trying to go in and digesting it, and asking the new chatbots to create stuff for us. We are all programmers. No, we can ask the chatbots to program for us. We can ask it to create art, videos, songs, everything. So think about the productivity that can come on the back of that. Think about the application. Think about, we can just do everything with it.
And Chaim, you talk about the increased productivity, but what does it mean more specifically for jobs, whether or not it is a job killer? Is it, or is that fear a little bit overblown?
I think it's going to be a job transformator rather than a job killer. Every time we see a development with technology, it actually helps to create more jobs. Some jobs will be under pressure. Think about the service industries, the heavy text industries like lawyers and so on. Their jobs will have to change. But new jobs will be created. For example, we believe that the total value add for global economy from using AI is up to close to $16 trillion by the end of this decade. So think about how much value add we can have that. Give it two historical examples. In the 80s, everybody thought that ATMs will be the financial industry killers. You don't need to give money anymore. A lot of the processes are going to be done automatically. What are all those bankers are going to do right now? Guess what happened? The number of bankers increased dramatically. Excel with accountants and finance and other things. So I do believe we're exactly in the same moment that yes, jobs are going to be under pressure and going to change dramatically, but the amount of value add will create new jobs and different jobs than we have right now. We actually believe this is going to be a net positive for the job market.
That's good news. Off the top, we mentioned C3 AI popping more than 30% shares today. Their CEO, Tom Siebel, was on the program earlier today. Listen to what he had to say about the future of AI.
I mean, AI is this is soon will be a $600 billion addressable software market. Everyone will be using enterprise AI applications, just like they use PCs, just like they use relational databases, just like they use CRM.
C3 is an early winner on this, as I mentioned, popping, there we go, 33+%. Can you throw on some other names you think are investable winners in this space right now?
Well, no, right. As I said, every industry will be impacted, but I think the immediate winners over here, as we had in our note, are probably going to be the picks and shovels, the basic industry, which is eventually processing power, hardware, data centers. The amount of processing power we need to train AI is unprecedented. Actually, the amount that we use right now have outperformed the Moore's law by the factor of 6, and will still continue to go up on the amount of processing, GPUs, and so on. Big winners from all of this. Data centers. We are generating so much data. We need to store it. We need to analyze it. So data center companies are definitely going to be a big part of all of this together. Some software, as the CEO have just highlighted over here, they can start using it. Cybersecurity, for example. Think about the amount of applications that could be used on the back of that. So I think those companies and those industries are definitely going to be big winners over here.
All right, Haim Israel, great to have you. Really interesting note. Thanks so much for joining us here this afternoon. Have a good weekend. All right, we are just getting started here on Yahoo Finance Live. Coming up, Netflix is going live, the company pushing into live shows. We will discuss whether this gives the streaming giant a leg up in the streaming wars. Then we will talk to Exponential Fitness founder and CEO will join the program to discuss the company's fourth quarter results, why he's seeing strong demand at his gyms. Any recap of the week that was, we saw a slew of earnings reports, specifically within the retail sector. We'll tell you what it means for you and the consumer. Stay with us. Bitcoin shares is sinking today. The crypto world grappling with the crypto-focused bank Silvergate Capital's solvency fears. You're looking at a drop of nearly 5%. Jared Blickery is in the studio with more. And Jared, you're saying this chart, it's all over Twitter this afternoon.
Yes, and this morning, this happened at about 8 p.m. Eastern time last night, UTC around midnight. And let me just show you the two-day view. We haven't seen a drop like this in weeks in crypto. So yes, this happens fairly regularly, but there's been a lot more stability than usual lately. Let me just show you a longer term chart here. Here's a 3-month. I'm going to put some candlesticks on here. We are still in an uptrend, a short-term uptrend here. Haven't exceeded this low here. So we're going to want to watch, what is that, 22,000 or so. If we come back down there and get below, that could be a worrying sign because 25,000 was a huge level. So is 30,000, but the inability to get through here means there could be some more sideways basing action, or fears are that we could have another large liquidity event in crypto, and that could send things a bit lower. Let me show you something else here. Silvergate earnings were kind of the catalyst for all of this. They were not able to file their 10K, their annual report, on time. As a result, their shares were tumbling. Now, Silvergate is the banker for a lot of crypto enterprises, and this has huge repercussions. To lose over half of its value in 3 days is something to behold. And I have a few analyst quotes on this. Here's Canaccord Genuity on Silvergate. By the way, they're downgrading to hold from buy and lowering their price target to $9. The bank, to some degree, has become a lightning rod victim of circumstances, given industry news flow over the last few months. We are not aware of any chartered bank in U.S. history that survived such a deposit drawdown, as did Silvergate post the FTX collapse last year. And guess what, guys? That includes the Great Depression as well, I would think. Wedbush on Silvergate, they're maintaining their neutral, lowering their price target also to $9. We believe the crypto market could remain suppressed with elevated interest rates for the next couple of quarters until the Fed pauses rate hikes, and that's where we go. That's where we are. This is usually about the Fed. Here's Marty Zweig's investing rules. Don't fight the Fed. That's number 6. He also says, don't fight the trend. The trend is your friend. Don't fight the tape. So what does this all mean? We have a short-term uptrend in place in crypto, but it is potentially in jeopardy right now. So we'll have to see where this comes, but a little bit of bad news, and we have Bitcoin open for the entire weekend, guys. So think about that as well.
Some more Twitter material there for the weekend, Jared. Thank you, sir. All right, crypto exchanges, FTX new executives say they have found a $9.5 billion shortfall in crypto and cash needed to repay customers. To break it all down, we go live to Yahoo Finance reporter David Hollerith. Dave, what are we learning?
Dave, so yesterday in a press release, the FTX's interim CEO, John J. Ray, said it's taken a huge effort to get this far, and the exchange's assets are highly commingled. And that means that all these results as of now are still very much preliminary, meaning that they could change. So FTX has a $9.5 billion shortfall in crypto and cash to repay customers. And just 694 million, $694 million in assets and 2.2 billion have been recovered and are easily sellable, meaning liquid. The group said it also lent $9.3 billion to Sam Bankman-Fried's Alameda Research, FTX being the entity there. And the shortfall for FTX US, the US subsidiary, is smaller but still significant. It's $427 million against 335 million customer claims and 283 third-party claims. So that's what we have as of now with FTX.
All right, Dave, and you're also tracking the latest between the SEC objecting to the Binance's proposal to buy Voyager. What are we learning at this point?
Yeah, so yesterday and today in a U.S. bankruptcy court in New York, essentially the judge has been presiding over examining this plan for Voyager to sell customer accounts and its remaining crypto assets to Binance US. Binance US being a US cryptocurrency exchange that's affiliated with Binance International, but a separate legal entity. And that deal has become contentious. Federal and state regulators, as well as some Voyager customers, creditors, customers turned creditors, have filed objections since. And they've shown up in the last 2 days to cross-examine some people advising Voyager on this deal. Now today, we also saw CZ, the CEO of Binance International, again, as far as we know, not a part of this transaction, take to Twitter, essentially to sort of, he made a joke about whether or not they should pull out of the deal, but then went back to reiterate the support of Voyager or of Binance US purchasing the assets. But the judge has been critical of both the SEC's argument not yet offering enough evidence for why the deal can't go through. And also regulators have been critical, including the SEC, of Voyager's advisors, asking them some sharp questions as to Binance US's solvency.
All right, David Hollerith, good to see my man. Enjoy the weekend. Coming up, the future of Netflix. We'll discuss the streaming giant's move into live stream broadcasting ahead of Chris Rock's stand-up comedian special, what it means for their competitors in the space when we return. All right, well, Netflix is going live. The streaming giant will be airing the highly anticipated Chris Rock live comedy special on Saturday, bookended by pre and post shows. It's the first ever live stream broadcast for the company. For more on this, let's bring in Michael Pachter, Wedbush Securities Managing Director of Equity Research. Michael, it's great to see you again. So certainly it's a big test for Netflix. What do you think of this move, venturing into the live streaming game?
It's a free publicity move that's going to have no impact on their business, but it's going to get people like you to turn it into a news feature. And you're not the only one. You're about my 10th interview on this one. They need programming. The idea that anybody's going to turn on Netflix by appointment is idiotic. We don't even know when regular TV shows are on. I think the last show I used to tune in real time was Friends at 9 o'clock on a Thursday night. And that was 25 years ago. We use our DVRs. We've all been trained by Netflix that whatever we want to watch is on demand all the time. And in fact, we're all pissed when something like The Mandalorian comes out on Disney Plus and season 3 came out on Wednesday and there's only one episode. We don't get them all. So this whole concept that Chris Rock's going to stand up live and I'm going to actually show up Saturday night to watch it, it's not any worse if I watch it the first time on Sunday or a week from now or a month from now. They're doing it solely for the publicity. This is not the same thing as signing a real live stream deal like a sports deal, which I don't think they're going to do. So Netflix is still Netflix. It's no different than it was in the past, but they managed to get news media organizations to report on this.
Your cup overflows with enthusiasm, Michael. I will
disdain is the right word. Go ahead, sorry.
I'll tell you, I would agree with you for the most part, except for this is a cultural moment because we're all waiting for him to respond to the infamous slap from Will Smith right ahead of the Oscars, which are next weekend. This is a moment that I think has a lot of buzz, and yes, because of organizations like ours talking about. What number of live viewers will convince you that you're wrong here?
Well, what number of live viewers saw the slap? in the Oscars. I think it was the lowest rated Oscars of all time. So what is that? I don't even know in the US. 10 million, 20 million. There's no chance it'll be 20 million. 0% chance at 20. And, harken back to the days of shows like The Blacklist season 1. It got 20 million viewers, per episode. And the show 24 got 20 million viewers who tuned in real time. This thing, 5 million? Sure. Who cares? It's not going to move the needle. No one is signing up for Netflix to watch this show on Saturday. And oh, by the way, 5 seconds after the joke about Will Smith's slap, it's going to be on Twitter. So who cares? I'll read about it on Twitter.
Michael, you've got two people here that will probably most likely be tuning into it live. Yeah, I'm in. I'm excited. Yeah. Maybe it's because we're part of the people that are hyping it up. So, Michael, you're not excited about this. Netflix has resisted any sort of venturing into live sports. Would that make sense to you, given the number of eyeballs that it does draw in real time?
No, live sports is a hook to keep someone subscribing. So, it makes sense for a cable provider, for Comcast, and it makes sense for a retransmission company like CBS or NBC to buy sports rights. I think Google's going to fail miserably with the YouTube purchase of Sunday Ticket. I think that's going to end up being a disaster for them, but it's going to hurt DirecTV at the same time because you're going to see people start to cut the cord. The one company out there that's kind of built a whole business on this is Fubo TV, the ticker FUBO. The stock's gotten crushed because they're not yet profitable and they're still burning cash, but they are a live broadcast channel, all streaming, and it's mostly sports. I mean, they have all the other networks as well, and they can't make money. So, if they're not making money focusing on that, YouTube absolutely is not making money on YouTube Plus. Amazon, no chance they're making money with Thursday Night Football. So I don't think live sports is the way to go. The sports leagues have established that their rights are worth billions of dollars, and Netflix just doesn't have billions to spend on that. And we don't think of Netflix as a by appointment television broadcaster. We think of them as an on-demand when we feel like it and binge the whole thing. So we're perfectly happy to tune into YouTube or tune into Amazon Prime, because we're all Prime members anyway, and watch football. We're not going to join Netflix for that. No chance.
They've made a shrewd entrance into sports with some of the series, Full Swing and Drive to Survive, the new partnership with the NFL, profiling Patrick Mahomes and other quarterbacks. But let me ask you, you've got an outperform on a 410 price target here. That's more than 30% upside. What do you love about the long-term outlook for Netflix?
Oh, I mean, you said I was full of enthusiasm, and I said disdain. I love their spirit. So look, as much as I criticize them for dumb moves like this, I like that they keep getting up after getting just knocked to the ground, and they keep fighting, and they keep trying. They had the crap kicked out of them for a brief period of time. They stopped growing subscribers, and they took a look in the mirror and they said, what can we change? They added an ad-supported tier. That was really smart. Not that it's going to attract that many new subscribers, but it's going to keep people from quitting. Anybody who's paying $15.49 a month, who says it's too expensive and I don't watch it that often, they have to think hard about trading down to $7 a month with some ads, and they probably will. So I think you're going to see a reduction in churn, which results in higher net new subscribers added, because they're going to keep the old ones and add the same number of new ones. And when they grow for 2 or 3 more quarters, the stock hits my target. Let's revisit after that. I think that there's opportunity there for profitability because they're cutting their spending. And as long as they don't do stupid things like bid on sports rights and do really smart things like bid on Chris Rock live, so you talk about it, I love the stock.
Eagerly awaiting the Chris Rock stand-up special, Michael Pachter. We love it, man. Like your enthusiasm. Thank you, sir. Enjoy the weekend. All right, coming up, Apple shares popping today. Morgan Stanley citing 5 underappreciated catalysts that could boost the stock higher this year. We'll tell you what they are on the other side of the break.
time for a triple play. 3 stocks that we're watching in the final 30 minutes of the trading week. We've got Apple, Amazon, and Volkswagen. My pick today is Apple. Morgan Stanley confirming it as a top pick, making the case that investors should look past some of those near-term challenges and saying that the stock could rally another 20%. So here's why. 5 underappreciated catalysts in their view that can drive a re-rating over the next year. Here are the 5. Reaccelerating iPhone and services growth, record gross margins, 2 new product launches, the potential for an iPhone subscriptions program. Now, Morgan Stanley's new price target is $180 a share, about $30 higher than where we are today. Their bull case, though, saying that it could get to $230 a share, unlocked by that subscription shift that we have been talking about. We have been waiting now for quite some time. When it comes to Apple, we know Apple might have a rocky couple of months given the macroeconomic environment, which they did point to in this note, but they're bullish on the long term.
Yeah, and they wrote in the note that historically you want to own Apple stock about 6 to 9 months before they unveil a new product. They have the new AR/VR headset. They have the Apple iPhone 15. Of course, I literally just bought a new iPhone.
That's how it always is.
But here's the thing, Apple, they just have a way to keep you in their ecosystem. I didn't need a new phone. My phone worked fine. Yes, the battery life was not good. The picture quality, not the best, but I didn't need it. But they just have a way of making you think that you do. And there's a reason why they've been so successful. They know, they've been around the block. They've weathered a lot of storms. And I think that's important when it comes to their success.
We're hooked.
We're hooked.
It's addiction. We talk about ecosystem, but it is addiction to all things Apple. But what is that new iPhone? It's rumored to be in September, the iPhone 15. They haven't had a big step forward in a while in terms of the phones. I have no reason to upgrade. I don't know about yourself.
I do.
But I just don't hear a lot of buzz to upgrade to new iPhones in recent years. And unless they come out with some dramatic change, which it's not entirely clear what that could be, I just might pump the brakes a little bit on bouncing back in terms of iPhone sales this year until there's a big evolution, which we haven't even heard a whisper about.
Yeah, it will be interesting to see if maybe some people will be upgrading maybe more than they initially were planning to this upcoming cycle, given the supply issues that Apple did see during its
because
very
they didn't get the
holiday
14.
issues, because they didn't get the 14.
Okay,
so
that's a
maybe
good
that could
point.
boost sales here for the next cycle. I don't know, but that could make sense to me.
I think the hardware subscription service, which we've heard buzzed about, that they mentioned in the note, that could be really interesting. Because to Allie's point, we would all pay for it.
I'm curious though, what version?
I have a 10. That's why I'm like,
know.
I need to upgrade.
You need a new one.
I don't even know.
But it's over $1,000.
Well, you have more than one camera, so that's good.
Okay, there
that's
you
a good
go.
thing.
You have a reason. I want to say you have a 12.
Oh, you only have 2 cameras
We've
though.
discussed this before.
I have 3. Okay, anyway, from APL to AMZN, my triple play is Amazon. Shares are up about 3% right now, despite news the company is pausing construction of its second headquarters known as HQ2 in Arlington, Virginia. According to a statement provided to Yahoo Finance, Amazon said it's reevaluating its real estate plans for phase 2, but said it's still committed to the project with more than 8,000 people already working in HQ2. That being said, Amazon CEO Andy Jassy has had to make some tough decisions lately, with the tech giant laying off more than 18,000 employees earlier this year, the largest layoffs in the company's history. This amid slowing revenue growth and a shaky macro picture. We also got the news today that Amazon will be cutting 8 of its cashierless Amazon Go locations as sales slow. And guys, it feels like, after COVID, after the pandemic, we had this rush in hiring. Now all these tech companies are having to deal with the aftermath of this, coupled with, the return to office hasn't really been what people thought it would be. So Amazon just one of many companies caught in this crosshair.
Yeah, that return to office has taken an interesting turn out there, as Andy Jassy wants 3 days a week starting May 1st. 15,000 people joined an internal Slack channel and signed an internal position to complain, and then became a flip side, 700 plus pro return to office employees are now fighting internally over that policy. I think what's interesting, this is just Jassy really disciplined. The opposite of his predecessor. He had 100,000 square feet as part of that Virginia HQ2, 100,000 square feet of retail, not just the office. So I think this is what you're seeing across the country. They're also pumping the brakes in Nashville and in Washington on some real estate. It's not a good environment for the commercial real estate sector overall. That concerns me.
Yeah, exactly. And I was going to say, given the size of Amazon, the ripple effects that sends throughout the economy, clearly when Amazon makes a move like this, many industries take note, specifically commercial real estate, and this obviously will be a concerning trend here if we're seeing more and more companies make similar types of decisions.
Yeah, they had 322-story buildings planned. My play is Volkswagen, trending today on Yahoo Finance after reporting a strong 2023 sales outlook. The company says it expects sales to rise by 10 to 15% and operating margins between 7.5% and 8.5% this year. A global chip shortage caused by, of course, the COVID pandemic really stifled automakers around the world last year, but the VW CFO says now, quote, "We expect the supply chain bottleneck to gradually ease in the current year, allowing us to service high order backlog." Great news for VW. Reuters also reporting Volkswagen is discussing 2 new North American plants, one production plant, the other a battery cell factory. Their goal, 10% market share in the United States. The stock up big time today, as you can see, and still very cheap stock. It looks like supply chains are easing, which will really change the entire environment in the automobile sector, because the model last year was fewer cars, higher margins. They're going to keep the margins high and get supply chains open up. That's great news for investors.
Yeah, it certainly is great news for investors. It will be interesting to closely watch the auto segment just in terms of demand, what we could potentially see in the second half of the year, given the fact that we are expecting to see a slowdown in the economy. Higher rates could spell a little bit of trouble for that sector. Volkswagen, though, when it comes to the EV race, this is something that EVs accounted for just 7% of their group deliveries last year. We know that's so important just in terms of the future plans, the rollout of their electric vehicles, where they stand in that race. I think that's also going to dictate a lot of the trading action soon.
Yeah, and it's nice to finally see some optimism surrounding the automotive sector, because obviously the chip shortage, surging energy prices on the heels of the Russia-Ukraine war, this is a sector that has been through a lot. But Shauna, to your point, there's a lot of headwinds out there. We're still in this unfavorable macro environment. Outlook's great, but can they actually deliver on those projections?
We'll talk more cars in a bit with Ford.
Oh, yes, we are. I was like, what are you talking about?
There
we go. Reminding me of the stories that are coming. Okay. Coming up next, though, many workers dream of retiring early. Well, our next guest is telling us how to make that a reality. We've got that for you after the break.
Welcome back to Yahoo Finance Live. Time now to talk about getting retirement ready. Brought to you by E-Trade. Today we're taking a look at how to think outside of the box when it comes to retiring early. Some Americans are utilizing what's called the FIRE method to achieve this goal. This financial independence retire early strategy requires followers to save a significant portion of their annual income and withdraw only about 4% of their savings annually. Tanya Hester is the author of the book, Work Optional, Retire Early, the Non-Penny Pinching Way. She joins us now. Nice to see you. So let's talk about your personal story, which of course you write about. When did you retire and how'd you do it? How'd you go about it?
Hi there. Thanks for having me. I retired at the age of 38, and that was almost 5 years ago now. And I like to say that the story was pretty boring. My husband, Mark, and I just saved a big chunk of our income and let time and the magic of compound interest do the rest. So it's not that interesting a story, but certainly being able to save a good percentage of our income helped us. That's something that not everybody can do. So we were really lucky in that way. But yeah, mostly it's just time and compound interest.
I have to ask the obvious question. Do you have children?
No kids, so that for sure makes things easier.
Therein lies the key.
Makes it a lot easier, as I've recently found out being a new mother. Tanya, let's talk about how exactly you got to where you are, because I think a lot of people watching this segment are very envious. I think a lot of people have a goal to retire as early as they can. So the 1, 2, or 3 steps that people can take now, that they should take now to better position themselves, what should they be?
Yeah, I think putting yourself in a position to retire even a little bit earlier than you otherwise could is a really smart move. So whether you can retire in your 30s or 40s or not, certainly that's not something that's accessible to most people, given how much the cost of living is increasing. That's reality. But that said, we know that 2/3 of people don't get to decide when they actually retire. They are forced out of work by illness or needing to care for a loved one, or perhaps they get laid off and then can't find another job. And so looking to retire in your mid 50s, 56, 57, 58, is certainly something that is going to put you in a much better, more secure position than planning on working until 65 or 70, because that's just not the reality for most folks. So I think looking at your budget, seeing if there are places where you could trim a little bit, or my favorite method and what really worked for us was to say each time we got a raise, even if it was small, could we bank that raise? Could we keep our spending the same as it had been the year before, more or less? And I know that's hard to say now with inflation where it is. But if you can even just get in the habit each year when you get that raise of saving a little bit more and a little bit more, it's pretty incredible what that adds up to over time.
I've pretty much accepted putting 3 kids through college. I will never retire. But Tanya, what are some of those common areas that people overlook that could actually make a difference when you focus in on it over the course of a year?
Yeah, most people tend to look at the kind of nickel and dimey places where their money is going, but I really recommend you start with the big things. So the big things for most people are housing and transportation. And so we have this culture, especially in America, where you get a starter home and then you move up to the next home, and then people are always aspiring to something bigger, but perhaps staying in a smaller home could be a good solution to help you save a whole lot more and invest a lot more over the long run. Or transportation, perhaps you could downsize, lose a car for the household, or look at other ways to cut your transportation costs. But it's also, it's really good to look at your overall spending, not sort of the theoretical budget that you imagine, but look at where your money's actually going. In the case of my husband, Mark, and I, for us, when we did that, we discovered that we were spending a lot more at restaurants than we thought. And so that was actually a pretty easy place to cut, because I think folks get scared that they have to give up stuff. And that's really not what I recommend. I think instead it's about scaling. So for us, it wasn't, can we eat at restaurants and get takeout multiple times a week or not? No, it was, can we cut back by half, perhaps? And so we did that, and we looked at kind of incremental cuts over time that felt pretty comfortable, didn't feel like big sacrifices. And that's really how we got there. So I think for a lot of folks, look at those big line items first. You'll get a lot more bang for your buck that way than trying to figure out, where every single nickel is going.
Tanya, when we talk about retirement, I think a lot of the focus is always on 401ks. If you don't have that option or are looking for additional avenues to save for retirement or places to keep your money, what should people consider?
there really are a lot of good tax-advantaged options out there. So for folks who don't have a 401k or a 403b or something like that offered at work, there are, of course, your IRA, Roth IRA options, and there are things like the simple IRA and the self-employed 401k, which have the self-employed 401k especially has really high individual limits. So you can potentially save quite a lot that way. But even if you've maxed out your tax-advantaged opportunities or you just don't have very many, you can still save in traditional investments, like just having a brokerage account with a brokerage firm and buying regular investments. And the advantage there, you're not getting sort of the tax-free growth on the front end, but then when you take withdrawals, there are no age restrictions, no early withdrawal penalties. And in some cases, you've already paid some of those taxes on things like your dividends. So you're not looking at as big a tax bill at the end. So I think everyone has lots of options out there potentially. And then it's just a question of how much you can personally save or invest.
All right, time for a little discipline in the Briggs family. Tanya Hester, thank you so much. Enjoy the weekend. Appreciate it.
Thanks for having me.
Coming up, Meta slashing prices on its VR headsets. We'll tell you how much they're going to cost you next.
Let's take a look at shares in Meta. The stock popping just about 6% today. The company was named in one of Wall Street's notes as a beneficiary to AI. Also another big headline coming out to Meta today, announcing big price cuts to its VR headsets. Dan Halley is here with the details on that. And Dan, what can you tell us about these VR headsets and how much they're going to cost in the future here?
Yeah, so we have the Meta Quest Pro. That's their super high-end device. And then we have the Meta Quest 2. That's the one that's been on the market for a while. The Meta Quest Pro came out to basically middling reviews, and it started at $14.99. So that's a pricey piece of equipment there. They're dropping the price, though, to $9.99, which is a steep drop. And then the Quest 2, that's going from $4.99 to $4.29. That's for the 256 gigabyte version. Now, why are they doing this? Well, there was a report previously from The Verge, which had a comment from the VP of VR at Meta during an internal conversation, essentially saying that people who've recently purchased their devices aren't staying as engaged as those who purchased them previously, meaning the early adopters are true believers. Newer people are like, meh, it's not that interesting for me. So it could be that they're trying to clear out inventory, prepare for the next Quest 3, or that they're just trying to entice more people to buy.
We will see. I'm a bit skeptical on them. I'm not going to lie. Dan Halley, thanks so much. All right, well, coming up, we are counting down to the closing bell on Wall Street. Once again, we are looking at gains across the board. The Nasdaq leading the way, up nearly 2%. We'll be right back.
All right, less than a minute away from the closing bell. That's time for Yahoo Finance's Jared Blickery to break down the market action as we wrap the week, and it's pretty positive action, man.
Pretty positive. Check out these 2 days on this 6-month chart of the S&P 500. It is off to the races. Really constructive day today in the mega caps. You can see communication services, tech, and consumer discretionary all up more than 2%. Then you take a look at some of the Nasdaq gains. There's the closing bell on Wall Street. We got Apple up 3%, Tesla up 3%, Amazon as well, Meta up 6%. So what can I tell you guys? Got to end with a bang here, right?
We certainly are ending on an upbeat note here. All three of the major averages in the green. Dow up just about nearly a 400-point jump to the upside. S&P up about 1.6%. Nasdaq up about 2% today. A lot of those larger tech names leading the way. You have Apple up just about 3.5%, Amazon up about 3%, Microsoft and Google all in the green. Well, let's talk a little bit more about some of the big movers of the week, and more specifically of today, because Ford was a mover that's on our radar, ending the day up just about 4%, ending the week up 10%. Now, investors cheering news that the automaker is restarting production of its F-150 Lightning electric vehicle. The Lightning coming alongside increased output of several other of its electric vehicles. That news hitting today. With more, Yahoo Finance's Proud Subramanian joining us, and you can clearly see the street's excited about today's announcement.
Yeah, another bit of good news to end the week, increasing production, like you said. First off, the Maverick and Bronco Sport going up 80,000 units this year. They're projecting that. The Mustang Mach-E EV doubling its run rate to 210,000 for the year for 2023. And that Lightning you mentioned, Ford reiterating that it's on track for 150,000 annual run rate by the end of the year. So, they had already said that before, but now they're kind of reiterating again. We'll see on this because, as you know, they shut down production for about a month with that battery issue. So they're going to restart that, and hopefully that'll catch up and be able to hit that run rate. So altogether, some good news there for Farley and Ford. And Q1 earnings can't come soon enough because that's when they can kind of prove that they're actually kind of turning the company around.
Yeah, that is some big news, creating a lot of jobs as well. I want to quickly ask you about, they shut down just a couple of months ago, Argo, and now we're starting up in that space, Latitude. What's the play here in the autonomous driving moves?
So they sort of took a lot of those engineers that they laid off from Argo and brought them back on in-house in this Latitude AI company. And they're focusing more on automated driving assistance features, not so much autonomous. So they think that the future is cruise and adaptive cruise control, lane departure warnings, things like that. They want to make software that helps the driver as opposed to taking over fully, is my understanding, at least right now.
That's a pretty significant shift. So really pumping the brakes, if you will, on fully autonomous. That's, I did not read that. Okay, Proudly Romanian, excellent take there, thank you. Pushback on the price of beer. Americans seem to be drinking less after mega beer companies increased their prices. Brooke DePalma is here with the details. Brooke, nice to see you. It is perfect to talk some beer on a Friday. We're just cutting it out though, huh?
We're just
dry January, just continuing throughout the year.
Drinking a little bit less because of those higher prices that they took last quarter. Ultimately, Anheuser-Busch's fourth quarter results saw that the volume of beer sold went down by 0.9% after it took those price increases. Now, total revenue was up because of those price increases by 10.2%. But the CEO said on the call that this was just a one-off, complicated quarter, they're calling it. But let's take a closer look at just how high those prices went up across the board in Anheuser-Busch's portfolio, up more than 8%. Bud Light leading the pack there, up 8.9%. That's according to Nielsen data pulled by Bump Williams Consulting. Of course, Stella, Michelob Ultra, Budweiser also under their umbrella. But other brands also took a price hike last year. Molson Coors up 9.1%. Corona Extra up 6.5%. Now, Anheuser-Busch did say that it was lagging behind inflation throughout most of the year and catching up toward the end. They did, in fact, call this, though, a resilient category. Now, earlier this year, Yahoo Finance spoke to Bill Newland, CEO of Constellation Brands, and he said following price increases there, the company saw short-term sensitivity, but also said people will be back for beer.
It's fairly recession resistant. I mean, the consumer still looks at many of the categories in which we play as an affordable luxury. And it's a critical piece of what they do for enjoyment. So I think we are going to continue to see this be an important category that does well.
And this concept of affordable luxury is not something that we're just seeing at beer companies. We're also seeing it across the board at companies like Starbucks and really banking on that fact here. And so we shall see what happens with the state of beer.
We will see, but one segment of the beer industry that's getting a lot of attention as of late is non-alcoholic beer. We talk about the fact that this market is just exploding. What did we see there? More specifically from Budweiser, but also from a number of the other companies that have reported this earnings season.
Yeah, well, Anheuser-Busch did say, in fact, that their no alcoholic beer portfolio delivered another year of double-digit revenue growth. Now, in fact, Budweiser Zero led the increase there. But what we're seeing across the board is other companies like Heineken, like Constellation Brands, Corona Zero. Other companies are beginning to introduce that non-zero alcoholic brands. They're expecting 5.5% year-over-year growth. That's according to an analytics company. And so what's interesting here is that Gen Z is really looking to this non-alcoholic beer, perhaps at gatherings that they're going to now. But in addition to that, the non-alcoholic beer drinker is not just someone who doesn't drink alcohol. It's actually someone who maybe drinks alcohol often, but sometimes prefers that non-alcoholic beer instead. And so lots of buzz there, I had to say it.
You had to, and it was interesting because that was what was promoted, the only thing that could be sold at the biggest sporting event in the world, the World Cup, because they didn't allow regular beer there. So Bud Zero took center stage. And this was the biggest dry January we've ever seen. If you ask restaurants, bars, they say they saw somewhere around 10% drop off this year. So that trend looks to be continuing. Brooke,
Absolutely.
Thank you. Great
Thank
stuff.
you.
Enjoy the weekend. All right, coming up, Exponential Fitness pumping more than iron today as its shares soar following earnings. The company's founder and CEO tells us what's attracting consumers to his gyms when we come back. Well, the pandemic shifted our spending in many ways, from goods to services, experiences, and travel in particular. Has fitness in that process become essential, with the parent company of Club Pilates, Row House, and Pure Barre showing a 44% increase in Q4 revenue? The answer appears to be yes, indeed. Exponential Fitness founder and CEO Anthony Geisler joining us now. Good to see you, sir, and congrats. The stock closing at an all-time high today. Why? What'd you learn in Q4?
Look, we had an amazing year. I mean, Q4 was great. Q4 was better than three better than two better than one. So we continue to see this 2022 cohort quarter over quarter continue to do really well. But ultimately for the year, I mean, we sold over 1,000 franchises, opened more than 500 stores, did over $1 billion of system-wide sales, and grew EBITDA by 170%. So you're right. Our members do view this as essential. Is non-discretionary for them. Our average member makes $130,000 a year and spends $130 a month with us. So it's not necessarily a meaningful part of their overall income, but it's where they drive their entertainment, their community, obviously, of course, their health and their workout. So it's a lot to give up for $130 a month.
Yeah, certainly it's reflected here in these membership numbers. You hit a milestone here in January, surpassing 600,000. You're talking about some of the momentum that you're seeing in your business. Looking out a year from now, what do you want to see that number reach?
I mean, look, we comped 25% year over year, 17%, in Q4 alone. So, we believe that we'll continue to see tailwinds from, other competitors that went out of business during COVID. There's displaced members and labor and real estate that we're able to take advantage of. Also, just people really taking their health and wellness way more seriously post-COVID than they did in a pre-COVID world. So, we continue to enjoy those headwinds, continue to build more stores and drive AUV. Even, our average revenue per store is an all-time high at $525,000 in Q4. And, we're seeing Q1 trending much the same.
See, we mentioned the brands, Row House, Pure Barre, Club Pilates, Rumble. Where are you seeing the biggest growth among those brands?
Well, we'll see the biggest openings or franchise sales really in Rumble and BFT because we just bought those brands recently. The 2023 openings will be in Club Pilates and Stretch Lab and Rumble and BFT. So, continuing to improve, AUVs across, all the brands. But those will be the ones that we'll see the most openings of this year.
Anthony, when you take a look at your stock performance since you went public back in 2021, you've done extremely well. And this compared to what we've seen from a number of other companies that went public around the same time. They've actually underperformed. When you take a look at Bumble, when you take a look at Sweetgreen, just to name two, significant underperformance there. What do you attribute that success to? And what do you think that tells us just about the direction of your company here moving forward?
Well, I mean, a couple of things. We went public the week they announced the Delta variant, so it probably wasn't the optimal time for a fitness brand to go public. So we came out undervalued, people not believing that, people were going to return to fitness. Obviously, they returned to fitness. They returned to fitness in a big way, bigger than they did pre-COVID, and we think that is here to stay. So, a lot of our success has to do with us, continuing to execute our business plan, our franchisees and our team here continuing to wake up every day and turn the keys and bring in great members and continue to retain them and grow their businesses.
There's that but lingering because we've seen the consumer show signs of starting to cut back. We've heard economist after economist with predictions of recession in the second half of 23. Are gyms, in particular, expensive gyms like these, recession-proof?
Yeah, I mean, I think everybody can't answer the question, how deep and how long is that economic downturn? I mean, for us, we sell in a reoccurring 4 times a month, 8 times a month on Unlimited with 50% of our members on the Unlimited. And we're not seeing any trade downs from Unlimiteds. We're not seeing any increase in cancellations or freezes across our brands. So, we've continued to hit all-time company highs quarter over quarter into these headwinds. So we believe, of course, there must be some headwind, but very hard for us to manage what that headwind is, given that the company continues to outperform itself quarter over quarter.
And then we talk a lot about the importance of loyalty here for consumer-facing brands, for companies like yours. I know you have the XPass for members. What do those membership numbers look like, and how big of a revenue driver is that for your business?
The revenue driver from an XPass is nominal, but what XPass does is it allows people to come into our ecosystem, kind of snack around on brands, and then find a home. So it's really a lead driver for us. It's a very creative way for us to acquire customers without, kind of going out to market and competing with our competitors on, Google search or Facebook, pay-per-click campaigns. We're able to do some of these, corporate B2B deals like we did with LG, where our X Plus appears on all the LG televisions, or Lululemon Mirror, or with Princess Cruises most recently, where we're building gyms on the boat, but we're also have our digital product in 23,000 staterooms, and people can leave purchasing a promotional XPass to take back home to go utilize in the locations around where they live.
All right, quick question. Talk me into Pilates. I've been working out for 20 years. It's one of my favorite things in the world, but I've never tried it. Why do I need to?
What do you do for a hobby? Do you play golf? Do you do anything, or just?
I take care of my kids. Golf, golf and working out. That's really it.
Yeah. So you'll golf better. You'll pick up your kids more. You'll have a lot more pain-free, flexibility with the kids. It's something much like yoga 10 years ago. Guys weren't doing Pilates. It was progressive. Same in yoga today. A lot of guys are doing Pilates. A lot of people are seeing the benefits in their golf game, their basketball game, and their parenting game as well. So
you had me at golf. My golf game sucks. So
you'll have to
that was a pretty compelling answer. You got to go to a Pilates class now.
All right, he had me.
All right, there we go. Andy,
Thanks,
guys, look great to have you. Exponential Fitness founder and CEO. Thanks so much. All right, coming up next, new data revealing where people are spending and where they aren't, as retailers warn about a pullback here from the consumer. The results, they might surprise you. Stay tuned. So retailers from Macy's and Nordstrom to Lowe's and Home Depot have been warning of a slowing consumer spending in certain areas of their business. Well, new data out from Citi today showing where exactly their card customers are spending this time around. Josh Schaefer is here with a breakdown of what those numbers are. And Josh, what are we seeing?
Yeah, so let's take a look here. So Citi's data shows various sectors comparing February card spend this year to spend in that same month last year. Up first, the worst performer, household appliances, spending down roughly 20%. Lowe's CEO Marvin Ellison noting in the company's earnings call, they're seeing similar trends as consumers are wary of a potential recession. Up next, you have electronics, this category down more than 8%, as consumers appear to be spending on more essential items like food at the grocery stores. Best Buy saying this week that despite a better than expected holiday quarter, they're, quote, preparing for another down year for the consumer electronics industry. And total retail also seeing a hit here in spending from Citi card users, down 6% on the year. Executives there have said it's a bit more of a picker's market where companies are balancing offloading inventories with too many promotions. And finally, let's end on a positive note, one of the few positive notes. Spending on pets remaining resilient, up 7.5% in February, up from last year, Dave. So I guess maybe you can cut back on all this stuff. You still probably got to feed your pet though, right?
No question about it, man. I got that new farmer's market food for my dog. Loved it. Loved it. Super Bowl commercial, remember that?
Yeah, they got you on board. It worked.
So how's this playing for stocks in those sectors?
Yeah, so the spending doesn't always add up with what we see in stocks, right? So we said spending down in home appliances. You can see that sort of playing out with Lowe's here over the last month and Home Depot over the last month. But when you take a look at both of those companies on a year-to-date basis, not nearly as bad. Lowe's basically even year-to-date. And a little bit down for Home Depot, but not nearly down as bad as those sales numbers, those card numbers that we were looking at. And then interesting when you take a look at Best Buy and we talk about consumer electronics, and you take a look at Best Buy over the last month. So you can see Best Buy down about 7%, 8% here, and I want to compare it to Walmart, another company that sells consumer electronics, but also is sort of buoyed by that groceries business we've been talking about. So you can see Walmart pretty much even over the last month, and also about even year to date. So Walmart holding up a little bit better than Best Buy because they have a little bit more of a diversified business there. And finally, the pet stocks, the exciting stuff. It's Friday. Let's take a look at Chewy. Chewy has had a decent little run year to date, up 8%. And then you take a look at Freshpet, also up almost 20% year to date. So those pet stocks have been performing well at sort of matching the card data we're watching there with people spending at the pet companies, guys.
Love that stuff. Pet spending. Let's keep it up. We love our pets.
Gotta feed the dogs.
Gotta feed the dog. Thanks, buddy. Enjoy the weekend. Okay, President Biden's student loan relief plan appears to be in rough waters as several Supreme Court justices casted doubt on the plan earlier this week. It's becoming a growing concern for millions of Americans that owe student loans, but a welcome sign for lenders like SoFi and its investors. Take a look at this SoFi stock, up more than 5% this week and up nearly 50% on the year. Pessimism is good for some. Our Rick Newman is taking a closer look in this week's Bidenomics. Rick, your biggest takeaway from the hearings this week and the implications, sir?
Yeah, the Biden's student debt relief plan is on death watch, basically. The justices who heard the case this week sounded pretty skeptical. Let's keep in mind there's a 6-3 conservative majority on this Supreme Court. In a lot of cases, their inclination has been to dial back federal government power rather than expand federal government power. And a lot of analysts think just based on the legal reasoning, they're likely to strike down Biden's student debt relief plan. And this is not just the usual behind-the-scenes political wrangling in Washington. The stakes are huge. I mean, there are like 43 million people who would benefit from this, and it would relieve up to $20,000 of student debt. And there is no plan B here, at least none that the White House has revealed. So if the Supreme Court does knock this down, that means millions of borrowers are going to be out of luck. Now, I think we will see the Biden White House try to do something else if that's what happens. But we're not going to see a decision here probably until about the end of June. And then it will probably be some time after that before we hear what the Biden administration is going to do about it. But I think these are going to be a tense few months while we wait for this Supreme Court decision, at least for student debt borrowers.
Yeah, Rick, you mentioned that something else. Any idea what that could potentially look like or could potentially be here from the Biden administration? How do you think this really affects potentially his approval rating, given that he promised debt relief to millions of Americans time and time again?
Well, Biden can say one thing to the voters who really care about this, and that tends to be younger voters for obvious reasons. He can certainly say, I tried. I mean, he did actually put a debt relief plan into place. They got millions of applications for debt relief. The train was going down the tracks. That relief was underway. And then I think surprising nobody, there were these lawsuits challenging the constitutionality of this plan because he did it by executive order. And that led to the Supreme Court. So I don't think anybody in the Biden White House is surprised at the legal challenges or surprised that this ended up in the Supreme Court. And I don't think they'll even be surprised if the Supreme Court kills the plan. The question is, do they have something else up their sleeves that they will be able to offer in its place? And I think they're going to try, no matter what. I think Biden is going to keep trying to do student debt relief for the remainder of his term, because this is something he promised to voters in 2020. It's a big issue for progressives in the Democratic Party, and I don't think he's going to back down.
So how else could he find some of this money for students? And thinking about the political implications here, Rick, do you think either party pays for this? And I don't mean financially, I mean pays at the poll.
Right. So this could be a little more potent as a political issue in 2024 than it was in 2020, if only for the fact that Biden put it in place and a conservative Supreme Court, or call it a Republican-dominated Supreme Court, killed the plan, if that is in fact what happened. So it's not a matter of finding the money. It's a matter of finding the legal justification for this. If Congress wanted to do this by passing a law, that would probably withstand a Supreme Court challenge. And the reason is, if Congress made a law, then the law itself would be on the books. And what's happening now by doing this through executive order is that Biden is interpreting old laws, in this case, one dating to 2003, that really were not about student debt relief, at least not the way Biden is doing it. And he's saying that old law that was really intended for something else gives me the authority to repeal all of this debt. And the people challenging that say, no, it doesn't. And it looks like those opponents of this have a pretty good case to the Supreme Court. So what Biden could do is try to find a different legal justification for this and do it all over again through another executive order. That once again would probably go through the courts. He could also try to build on this other plan that has gotten a lot less attention. It's a way to adjust what borrowers owe based on their income. Biden made that plan more generous earlier this year. And there are ways you could change that plan a lot more that would effectively become debt forgiveness over time. But it's complicated. All of these things are subject to legal challenges. If the next administration comes in and doesn't like any of this, they can undo it. So really uncertain where this is all headed.
Yeah, and no way $400 billion in student loan relief gets through the House. Zero chance, leaving this country with a massive debt bomb down the road. But what else is new?
No, I mean, I'll point out that Democrats couldn't do this when they controlled both houses of Congress. So there's no chance that if Republicans have any control over Congress, this will happen.
Very good point. Enjoy the weekend. Read that Bidenomics right now on Yahoo Finance. Thank you, my friend. Coming up, 4 straight weeks of mortgage rate hikes are putting homeowners in a pinch. But find out if it's actually slowing down the housing market after the break.
Potential home buyers are getting squeezed by higher mortgage rates, and low inventory levels are keeping prices high in the majority of cities. But Goldman Sachs is out with a new note revealing that of the largest 25 metro areas nationwide, 4 of them, Austin, Seattle, San Francisco, and Phoenix, you're looking at them on your screen there, have higher inventory levels than pre-pandemic, and they're actually dealing with an oversupply. Danny Romero joining us now in studio. And Danny, this is pretty fascinating because we talk about the fact that inventory levels nationwide in most cities are very, very low. What's driving this? What do you think is factoring into this oversupply in those cities?
Shauna, just not a pretty picture for the West Coast and the Southwest regions. Like you said, supply is outpacing demand. So, for example, if we move over to the West Coast in San Francisco specifically, it's one of the most expensive cities in America, and home values have drastically declined. Another reason is that the pandemic caused a massive exodus of residents looking for more space, affordable housing in other towns. And you also have to realize that San Francisco is part of Silicon Valley, and the tech industry has been hit by massive tech layoffs. And even though these workers are finding other jobs in other markets, it's still impacting the region. The good news, though, is that home prices have fallen in this area in San Francisco, so there's not really much competition, which is a really big incentive for sellers, right, to bring buyers into that market. Now, if we move over to Phoenix, Arizona, home prices there have also fallen, home sales, have fallen there, really cooling off from the pandemic frenzy that we saw, right? Due to those higher mortgage rates. And, you know, we saw mortgage rates bounce back up towards that 6%, really crushing home buying activity for the moment. But Goldman Sachs does note that the housing outlook looks less dire, and they're expecting that home prices will fall around 6.1% as mortgage rates head toward that 6.5%. The issue, though, still remains that there is just a big supply of multifamily units, which will really challenge the rental market.
It's interesting. Those 4 cities that you mentioned there, the people you worry about are the ones that bought at peak COVID prices. They're going to get crushed in that 2-year period. But the people that bought prior to it are still going to see an increase over that period because prices went up larger than the numbers we showed. I don't know if that makes a whole lot of sense to you, but again, the people that brought prior to that massive increase, they're going to be fine. Their price is still up over a 3-year period. If you bought right in the middle, oh boy, you're going to get crushed.
For the values to get back
they're
up.
still making some profit off of their what they bought. Yeah.
Interesting. Danny, thank you so much. Appreciate that. Have a good weekend. Just as the housing market appeared to have, for the most part, weathered the storm, some dark clouds are on the horizon in the form of higher rates. Home prices were up nearly 6% year over year in December. That's down from a 7.6% gain in November and nearly a 4.5% lower than their June peak. And although they slipped a bit at the start of the year, mortgage rates have climbed even higher this week, with the 30-year fixed now 6.6% and the 15-year just under 6%. And earlier this week, Moody's Analytics chief economist Mark Zandi told Yahoo Finance we've still got a ways to go until we find some calmer waters.
The one thing that is dead ahead, though, is more house price declines. I mean, to restore affordability, mortgage rates have to come down, incomes have to rise, and or house prices have to fall. And I think we'll get some combination of all three. So that means some further house price declines dead ahead. Now, prices have been falling for the last 5-6 months since last summer. I expect them to steadily decline through 2023 and into 2024. I think we see about a 10% peak to trough decline in price. We're down 2 percentage points already, so we're kind of 1/5 the way through the adjustment process.
All right, let's talk about this with Redfin chief economist Daryl Fairweather. Daryl, you heard Mr. Zandi there talking about the real estate market as he sees it and where it's going. Anecdotally, what are you seeing right now with these higher rates? It appeared that spring was coming, things were loosening up, but it feels like a tenuous time. What do you see across the country?
The housing market is much slower than it was this time last year. There are way fewer home sales, and there are fewer new listings coming on the market because many homeowners locked in a 3% rate just last year, and they don't see a reason to sell because there'll be buyers again. And buyers, of course, are facing high mortgage rates that makes it much less affordable to buy a home compared to last year.
So what does that mean for inventory levels? It doesn't seem like many more homes are going to be coming on the market anytime soon.
Yes, if you look on Redfin right now, you will see more homes for sale than you would have seen this time last year. But a lot of that inventory is stale. It's homes that have been sitting on the market, probably a bit overpriced, and have not yet attracted a buyer. And there are very few new listings coming on the market.
A month ago, mortgage rates were just above 6, and most felt, and it looked like they were going to sink below 6 and keep going down until the 5.5 range. And then boom, went straight back up, and here we are at 6.65. Are we headed back towards 7% on the 30-year?
Buyers are incredibly sensitive to rates. So anytime mortgage rates come down, they come right back to the market. And when mortgage rates go up, they leave the market. But with mortgage rates being so high, there's a chance they might go up. And a lot of buyers are just kind of looking at the market and thinking now is not the best time.
So Daryl, within your forecast, though, what you guys are anticipating over there at Redfin, are you expecting this trend to the upside to continue, though?
We expect mortgage rates to fall below 6% to around 5.75% by the end of the year. But in between now and the end of the year, mortgage rates could come up and come back down. Now, the Fed is going to stay committed to fighting inflation, and that should eventually drive mortgage rates down. But it really is anyone's guess as to how long that will take.
Would you spotlight a particular region in the U.S. right now that seems just to continue to grow regardless of where the mortgage rates go? I mean, is it the Southeast? What's the region that just stays hot through all the conditions?
It's not so much staying hot, it's the markets that have stayed stable. So the Midwest, for example, never really took off during the pandemic. So they don't have very far to fall at all. Sorry if you hear my kid in the background. But places like the Southwest, like Texas, prices really took off in Austin, and now it's a big function.
Daryl, what are you seeing just in terms of a lot of the home buyers, a lot of first-time home buyers are staying on the sidelines here. They're waiting for something to change. They're remaining hopeful, though, that they are going to somehow score a good deal in the second half or maybe towards the end of the year. Do you see that as a possibility at all?
I think it's possible. I think that the second half of the year could be very strong if mortgage rates come down. We could have a reversal of seasonality because, like I said, as soon as mortgage rates come down, buyers come back.
What are you seeing in terms of rents and where they're moving?
Rents are slowing. They're not growing very much at all. Now, they could come back given how strong the economy is and how low unemployment is, but it seems like rent growth is, for the most part, really slowed down, which is what the Fed wants.
All right, Daryl Fairweather, great to have you, Redfin chief economist. Well, coming up after a wild week of earnings in the retail sector, find out which companies are best positioned for success in the months ahead. We've got that for you when we come back.
It was a big week for retail earnings and consumer data. Here's a look at what happened in the world of the consumer this week.
Consumer confidence decreasing for the second month in a row in February. The index falling to a 3-month low on worries over a possible recession.
A decline entirely driven by expectations for the future. That means U.S. consumers keep feeling better about today and worse about tomorrow. We've got to talk about retailers, too. They're remaining cautious as inflation weighs on consumers.
We're just seeing a consumer that's making choices as they've seen the persistent inflation in a category like food and beverage, and that's taking a bigger piece of their share of wallet, and that's factoring into their purchase decisions.
I was at Costco this weekend, and let me tell you, those lines were incredible. As the consumer continues to gravitate and stick to those where value is everything for the consumer right now, they're looking for any way to save a penny.
Disinflation, like the Fed is out there talking about, is not necessarily happening. These companies are still dealing with high levels of inflation in their supply chain, and their customer base still dealing with high levels of inflation.
It's also a very bad macroeconomic situation right now where the consumers have shifted their spending. They're moving away from discretionary and sticking to staples. As a result, it's not the best scenario for the department stores in 2023.
I think the premium, the wealthier consumers are still doing well, and they're still pricing up, so to speak. Whereas the middle income and lower income consumers are not only scaling back some of their purchasing, but some of the features, some of the add-ons, some of the more premium components of leisure spend are beginning to tail off.
All right, well, the economic outlook might be cloudy, but the consumer is still buying. This news cheering on retailers that are capitalizing on some of the strong consumer spending that we are seeing here in the market. Joining us now, talk about those trends. We want to bring in Sucharita Kadali at Forrester Research retail analyst. Sucharita, great to have you again. So we heard from a slew of retailers out this week. We had Target, we had Costco, we had Macy's, Nordstrom, just to name a few. What was your overarching maybe theme that you are taking so far from this earnings season when it comes to the retailers?
Yeah, well, anybody selling grocery, anyone selling staples typically did okay. You're continuing to see relatively high single-digit growth for companies like Kroger and Costco, which is incredible because these are mature companies and the consumer is clearly continuing to spend there. It's in line with inflation, so there are a lot of effects that are going in opposite directions when you dig deeper. There's a lot of expenditure on private label goods. A lot of the brand name goods that did very, very well during the pandemic are not seeing the gains that they saw over the last few years. So many consumers are trading down from those brand name goods to those private labels. And what you're seeing is just the same number of units essentially being purchased, but going off into private label, not to some of those traditional CPGs that saw great gains in 2020 and 2021.
Do the private label increases extend into apparel and other categories of retail? And why so have they been so successful in the last few quarters?
Yeah, well, I would say that apparel in general has not been doing terribly well. So you'll notice that I didn't say that the department stores were doing quite as well. So you didn't see the strength in Macy's, you didn't see the strength in Nordstrom. And in fact, when you look at Macy's overall numbers, they didn't even comp their 2019 numbers, which really shows more of the overarching trend with department stores, which is that they've been on a downward trajectory, candidly, for the last 20 years. Now, in terms of apparel and apparel private label, apparel private label that does well tends to be at some of those mass merchants. So like Walmart and Target have pretty strong apparel businesses. And certainly consumers are trading to those departments within those mass merchants and going away from some of the higher end mall merchants where the consumer just has no appetite to spend. As we saw in the clips, the discretionary spend is down, particularly for physical goods.
For several months there, we heard about the inventory issue, probably most significantly pronounced at Target. Are we through that inventory in the retail apparel space in particular, or is it still some long road to go there?
The inventory issues were worst in late 2021 and through much of 2022. And then what you saw for Q4 was almost a retrenching and an overcorrection by a lot of merchants where they just didn't even order enough. And so in terms of inventory, driving any type of markdowns or consumption as a result of too much supply, we're not seeing that. And we see it also in overarching census data, which is that half of the issues now with inflation are driven by demand. There is the other half that's been driven by supply, but it's not as much in consumer categories. It's more in other B2B sectors rather than what consumers are buying, like for instance, apparel or even CPG.
Sucharita, when it does come to some of the department stores digging into the Macy's numbers, Bloomingdale's, Bluemercury actually did okay. Just what is your read just on the strength of the high-end luxury consumer and their ability here to weather some of the uncertainty that we could likely see over the next couple of quarters?
Yeah. So what's important to remember about like a part of a Macy's revenue, like a Bloomingdale's or Bluemercury, is it's still a minority. It's still small. But that's something that's important about luxury overall, is that it is a minority, very, very small percent of overall spend. Now, that said, is the affluent consumer doing okay? Affluent consumers are very challenged by the market right now. I mean, a significant part of their net worth is tied up in 401ks or their stock portfolio. And essentially their net worth over the last year has declined substantially. So they're not necessarily feeling super flush with cash either. Now, there are other things like, for instance, perhaps some of that net worth being tied up in home values or other parts of their portfolio, which have increased, but it's not a categorical positive lift in overall value for that consumer versus what we saw in like 2020 and 2021. So net. I mean, certainly some consumers may be spending, but I don't think that even luxury is immune from a downturn in 2023.
Shauna mentions Bluemercury. We heard Target CEO Brian Cornell talk about cosmetics and how they really outperformed most at Target. Next week, we'll hear from Ulta, who's up 10% this year and 40% in the last 12 months. Is the makeup cosmetics category now non-discretionary? Is that one of the consequences of COVID?
Well, the makeup category is a beneficiary of something that we call in economics the lipstick effect, which is that it's an affordable luxury for consumers that may not be experiencing, kind of gains in other places. So it's a way to indulge yourself in an affordable way, and it's something that we see happen in almost any type of economic hardship. Is cosmetics tends to do better because the consumer that may not be purchasing discretionary otherwise is choosing to purchase on some of these small price points that may be in the sub $30 range.
Sucharita, we also got the news out this week from Nordstrom closing its Canada business. It's going to affect about 2,500 jobs, so they're cutting costs there. The moves that Nordstrom has made over the last couple of months, and also the talk about the involvement here of Ryan Cohen. How are you reading that, the involvement there is from an analyst perspective, and whether or not you're maybe optimistic about a turnaround plan that we could see here from Nordstrom?
Yeah, and that was an interesting one because the word had been within the industry that the Canada stores were actually doing very well. They were often even, kind of recognized internally as being very, very high performers. The Canadian consumer is known for loving shopping in department stores. And I think in the initial years of those stores actually being open, they did do well. But I think that these were just casualties of the pandemic. A lot of those Nordstrom stores were located in the urban centers in Canada that just saw consumers leave, kind of those central business districts and not go shopping as a result. And it's been very, very difficult to recover from that. Any store that's dependent on tourism or dependent on that worker traffic, that worker in the office environment, they're going to suffer. And I think that's essentially what you saw here. And then you also layer on the fact that they still need to fix their U.S. business and figure out what's going on there. It just made Canada seemingly a management distraction.
All right, good stuff. Forrester Research retail analyst Sucharita Kadali. Thanks so much. Dig the glasses, by the way. Much cooler than mine. Very good look. All right, thanks so much. Coming up, we'll set the scene for some of the biggest stories investors will be following next week. Stay with us. All right, let's take a look at some of the biggest stories of the week in the markets. Tesla held its investor day earlier this week with CEO Elon Musk talking for about 9 hours, promising new factories, a grand vision. It wasn't 9 hours, it just felt like it. A grand vision for humanity and not much in the way of actual cars. The lack of news sent the stock lower, though it did recover a bit after the company posted a 32% year-over-year jump in China sales for the month of February, Shana. It was largely a disappointing performance, at least ingested that way by investors. Nothing really changed the dynamic, though, long-term of Tesla, just that they don't have an imminent detail or plan for a EV under that $30,000 mark. We talked to Dan Ives at Wedbush, admittedly a very bullish Tesla investor, wasn't overly concerned.
He was not overly concerned. He was actually brushing off some of the fear they were saying that a lot of the drop that we were seeing after Investor Day was a result of the run-up that we have seen in Tesla stock since the start of the year. But the lack of details, I just think across the board, is really what Wall Street took issue with. You mentioned the Master 3 plan there laid out by Musk. Not a heck of a lot of detail there. Succession, yes, Musk was joined by a number of executives up there from Tesla, but we didn't get any concrete details about a succession, and also just the lack of the details about that next-gen platform, additional vehicles there. I think the street was hoping for a little bit more.
We did see the Cybertruck. We got the most detailed video we've seen of it yet, both outside and inside the car, including the new tires, and some vague details about he does believe it will see its first deliveries in 2023. But we've heard that story numerous times before. Tesla's still up more than 80% year to date. So doing just fine by investors.
Doing just fine. All right, then we also had some big retail earnings. Most retailers painting a cautious forecast over consumer sentiment. This even as strong buying continues. Target earnings beat estimates with same-store sales increasing by 0.7%. That was higher than what Wall Street had been expecting. They were expecting a decline of about 1.7%. The company crediting strength in food, beauty, and household essentials. Costco reported a mixed quarter. Revenue coming in just a bit light here, but the company's CEO saying that there was weakness here in big ticket discretionary items, a headwind there for Costco. We also heard from Lowe's, which warned of the cautious consumer after issuing a softer than expected outlook. Obviously, higher prices, inflation, a huge headwind here for all of these retail names. In Costco's earnings call after the bell yesterday, inflation was mentioned by their CFO numerous times. In total on the call was mentioned over 30 times. Just really points to the fact that higher prices is such an issue here for a number of those retailers. And we talk about people trading down. Their Kirkland brand is doing very, very well, and the sales penetration there increasing just about 1.5%. So Costco's weathering the storm, but they look pretty well positioned here going forward.
If I take one pattern out of this week, it's private label brands. You mentioned Kirkland. Target saw very much success in the private labels, as well as cosmetics. We talked about that a lot. Blue Mercury had a great quarter, and Target saw a great cosmetics number. But you mentioned the buzzword, which really we saw from every retailer: cautious consumer. When we heard from the bank CEOs early in earnings, they talked about a mild recession. The buzzword in retail was a cautious consumer, where they are beginning to trade down. I think we'll hear a lot more about that ahead. And then there was Salesforce, wow, which posted fourth quarter results that handily beat estimates. Mark Benioff, software company making moves seen as appeasing, or at least holding off for now, calls from activist investors to change how the business operates, most notably dissolving its mergers and acquisitions committee. Benioff telling Yahoo Finance that the company has hit the, quote, hyperspace button.
All right, well, it is closing time here at Yahoo Finance. Let's take a look at some of the stories that we will be watching next week. Federal Reserve Chairman Jerome Powell will head to Capitol Hill for a semi-annual appearance before Congress on Tuesday. Now, Powell will address the Senate Banking Committee, and then on Wednesday, he will go before the House Financial Services Committee. Powell will likely face several questions about the Fed's rate hike plan and its ongoing fight against inflation.
Yeah, Elizabeth Warren wants to chime in there. Earnings season rolling on. A number of retailers report next week, among them Dick's Sporting Goods, BJ's Wholesale, Ulta Beauty, and Gap. Given the diversity of these retailers, we should get a good picture of where consumers are spending their cash and where they're holding back. Ulta in particular will be interesting, given the Target highlighted beauty as one of their stronger categories last quarter. That stock up 40% in the last 12 months.
Certainly been a huge winner here over the last year. Right. And then on Friday, we will get the big February jobs report. Economists are expecting 203,000 jobs to be added, with the unemployment rate unchanged at 3.4%. That will be a lot lower than the 517,000 jobs that were reported back in January. We will be looking to see if that number gets revised any lower. What do you think? Projections?
Yeah, it's going to be revised a bit lower. That number was way too hot, man.
It was hot. It was a very, very strong. I think it blew every expectation here out of the water. But that does it for us today on Yahoo Finance Live. Thanks so much for hanging in there with us today and this week. We will see you on Monday at 3 p.m. Eastern Time. Have a great weekend.